Stagflation in 2025 and the risks of crisis delaying measures. In 2025, the global economy is projected to encounter one of its most challenging dilemmas: stagflation. This combination of high inflation, stagnant economic growth, and rising unemployment is a nightmare for policymakers. Unlike typical economic cycles where inflation and unemployment move inversely, stagflation disrupts this balance, leaving decision-makers with limited and often conflicting policy options. Stagflation refers to an economic environment characterized by three critical factors. 1. High inflation. Persistent price increases reduce purchasing power. 2. Stagnant growth. Weak or negative GDP growth reflects an economy struggling to expand. 3. High unemployment. Job losses rise as businesses cut back due to declining demand and increasing costs. For instance, global inflation rates surged in 2022-2023, peaking at 8.8% in 2022, IMF data. While growth initially rebounded post-pandemic, by 2024, many economies showed signs of stagnation, setting the stage for stagflation in 2025. Crisis delaying measures. A double-edged sword. 1. Liquidity injections. Governments often inject liquidity into the economy to stimulate demand. For example, during the COVID-19 pandemic, central banks worldwide implemented unprecedented monetary easing. The U.S. Federal Reserve expanded its balance sheet to over $8.9 trillion by 2022. Short-term effects. Liquidity injections stabilize financial markets and prevent collapses. They keep credit flowing and support consumer spending. Long-term risks. Prolonged liquidity expansion creates inflationary pressures, distorts asset prices, and fosters speculative bubbles. By late 2023, U.S. inflation had only slightly cooled to 3.7%, demonstrating how challenging it is to unwind such policies. 2. Interest rate reductions. Lowering interest rates encourages borrowing and investment, often boosting short-term economic activity. Central banks cut rates aggressively during the pandemic, with the European Central Bank maintaining rates near 0%. Short-term benefits. Reduced borrowing costs support businesses and households. For example, U.S. mortgage rates fell to historic lows of 2.65% in 2021, spurring housing market activity. Long-term drawbacks. Persistently low rates lead to excessive borrowing, unproductive debt, and leave central banks with limited tools to address future downturns. 3. Fiscal stimulus. Governments deploy fiscal stimulus by cutting taxes or increasing spending. For instance, the U.S. passed stimulus packages totaling over $5 trillion from 2020 to 2022. Short-term effects. These measures inject money directly into the economy, supporting job creation and consumer demand. Long-term risks. Stimulus increases public debt, which rose to 137% of GDP in advanced economies by 2022, OECD. High debt levels constrain future policy options and can trigger investor concerns about fiscal sustainability. Lessons from history. The stagflation of the 1970s. The most notable case of stagflation occurred in the 1970s, triggered by the OPEC oil embargo. Crude oil prices quadrupled, leading to supply-side inflation, while growth stagnated in Western economies. Inflation surge. U.S. inflation peaked at 13.3% in 1979. Stagnant growth. GDP growth in major economies hovered near zero for much of the decade. Unemployment rise. U.S. unemployment exceeded 9% by 1975. Governments initially relied on monetary easing to stimulate growth, but these policies worsened inflation. It wasn't until the Federal Reserve, under Paul Volcker, aggressively raised interest rates in the early 1980s, peaking at 20%, that inflation was brought under control. However, this caused a severe recession, with U.S. unemployment hitting 10.8% in 1982. Why 2025 could be different and worse. 1. Persistent supply chain disruptions. The COVID-19 pandemic exposed vulnerabilities in global supply chains. By 2024, disruptions persisted, with sectors like semiconductors and energy experiencing shortages. The World Bank estimated supply chain inefficiencies could reduce global GDP growth by 1% annually. 2. Energy transition costs. The push toward renewable energy requires significant investment. Fossil fuel-dependent economies face rising costs, while green energy infrastructure remains insufficient in many regions. The International Energy Agency, IEA, projects global energy transition investments will need to exceed $4 trillion annually by 2030. 3. Geopolitical tensions. Ongoing conflicts, such as the US-China trade rivalry, disrupt global trade and investment flows. In 2024, tariffs on Chinese goods remained at elevated levels, contributing to higher import costs and inflation in the US. The risks of crisis delaying measures in 2025. 1. Accelerating inflation. Delaying a crisis through liquidity injections or fiscal stimulus could worsen inflation. For example, if the US Federal Reserve resumes monetary easing, inflation could climb above 5%, eroding real wages and consumer confidence. 2. Asset bubbles and financial instability. Crisis delaying measures often inflate asset prices. In 2022, US housing prices rose by 19%, fueled by low interest rates. Cryptocurrencies also experienced speculative booms, with Bitcoin reaching $69,000 in late 2021. If these bubbles burst, the resulting financial instability could deepen economic downturns. 3. Policy credibility erosion. Investors and consumers lose trust in policymakers when they rely on temporary fixes without addressing root causes. By 2024, surveys showed declining confidence in central banks' ability to manage inflation, with only 37% of Americans expressing trust in the Federal Reserve, Gallup. 4. Social unrest and inequality. Stagflation disproportionately affects lower-income households, who bear the brunt of rising prices and job losses. Poorly targeted crisis measures exacerbate inequality, fueling protests like those seen in Europe during the 2022 energy crisis. Alternative solutions to address stagflation. 1. Gradual monetary tightening. Central banks must prioritize inflation control through moderate interest rate increases. For instance, the Federal Reserve's gradual rate hikes in 2023 helped reduce inflation from 9.1% in June 2022 to under 4% by late 2024. 2. Structural reforms to boost productivity. Investments in technology, infrastructure, and education can drive sustainable growth. The OECD estimates that increasing digital infrastructure investment by 10% could boost GDP by 1.2% in advanced economies. 3. Targeted support measures. Governments should focus support on vulnerable groups and productive sectors. For example, Germany's targeted energy subsidies in 2023 helped lower-income households cope with rising costs while maintaining fiscal discipline. 4. Supply-side solutions. Addressing supply chain inefficiencies and fostering domestic manufacturing can reduce inflationary pressures. The U.S. CHIPS Act of 2022, which allocated $52 billion to boost semiconductor production, serves as a model for such efforts. Stagflation. The road ahead. Stagflation in 2025 presents a unique and complex challenge. Delaying a crisis with short-term measures may provide temporary relief but risks worsening long-term problems. Historical experiences, from the 1970s to the pandemic recovery period, underline the importance of sustainable reforms over temporary fixes. Policymakers must strike a delicate balance between stabilizing the economy in the short term and addressing structural issues to ensure long-term resilience. Their decisions will shape the trajectory of the global economy for years to come. What do you think about the challenges of stagflation? Are policymakers prepared to tackle them, or are they repeating past mistakes? Share your thoughts in the comments below, and don't forget to like, share, and subscribe for more insights on global economics.